The golden question. We've been seeing all-time highs in the stock market in 2020 and 2021. It's like one day's record is broken by the next day's record. Whether it's the NASDAQ, the S&P 500, or the Dow Jones, we wonder, how much longer can this go? Are we going to see a crash? Should I keep my money on the sidelines and wait for that crash? Hey, what's going on, guys? It's Nate with you today from the Millennials channel, where I teach you everything about money that school hasn't taught you. If you're new here, make sure to hit that subscribe button, the like button, and turn on that post notification bell so you know when we post. So in order to answer the golden question whether we'll see a stock market crash in 2021 or not, we'll have to take a look at a few things. First, we're going to talk about what a stock crash is. Well, a stock market crash is a significant drop in the stock market within a short period of time. This is usually a few days, maybe even a few weeks. The four major crashes that come to mind when I think of stock market crashes is first, 1929's Wall Street crash, 2000's dot-com bubble, 2008 financial crisis, and of course the March 2020 crash. So let's take a second to look back in history and see what caused these crashes. At the time when World War I finished, people started returning home, which caused a boom in the economy. People were spending more and celebrating that the war was over, and banks were loaning out money like no other. At the time, people had so much money that what they started to do is invest into the stock market. Because of the post-World War I boom in the economy, companies had such high expectations and set high growth estimates. It turns out that they weren't able to keep up with these estimates as production started to slow down, which ended up turning into smaller profits and less growth for these companies. With the lack of growth that companies started experiencing, they had to lower their wages for employees, and once you lower wages for employees, people have less money to put into the economy and then less money to pay off their debts. At the time, even though all these companies were lowering wages and people started becoming in financial trouble, the stock market was still on the rise. On October 15th, 1929, we experienced what's called Black Thursday. At the time, the stock market experienced an 11% fall. The following Tuesday, which is Black Tuesday, we also experienced a big hit to the Dow Jones as it fell 12%. For the next 3 years, we experienced a decline in the Dow Jones from its peak in 1929 of $381 to a low in 1932 of $41. Because of this fall that they experienced in the Dow Jones, people are now only getting 10 cents for every dollar that they put in just a few years ago. People are unable to pay off their debts, unemployment rises to a high of 25%, and banks all over the country fall, which causes the start of the Great Depression. When World War II came around in 1939, this created more jobs, Americans were able to spend more, the economy picked up, and in order to make sure that what happened with the last war doesn't happen again, institutions like the FDIC and the SEC were created. Fast forward 60 years to 2000, now we experience what's called the dot-com bubble. In the late 90s, we saw the internet usage go from 2.5% to 35% of the population. Combining this with the lowest interest rates that we saw since the 70s, this created an influx of internet-related companies. At the time, these companies had such high costs in order to run, but the speculation on their growth was so high that investors were still pouring their money into these companies. At the time, the NASDAQ rose 400% within a matter of 5 years and had a PE ratio of 190. To put this in perspective, in the last 5 years of this crazy bull run that we've seen, we've only had the NASDAQ rise by 170% with a PE ratio of 24. And taking into account what's going on with society today, we're seeing everyone move into these tech companies and tech companies becoming more involved in our society and our everyday lives. You know, EVs are on the road more. You see companies like Zoom that we use every day. The top 5 companies in the world are Apple, Amazon, Facebook, Microsoft, and one more that I'm missing, Google. And then 6, of course, Tesla. So we see tech taking over in today's world. That's why we see such a big rise in the NASDAQ today. This is what sets apart today's rise in the NASDAQ compared to the dot-com bubble back in 2000. Once the Federal Reserve started increasing their interest rates and selling pressures began, Japan also entered a recession. This caused many people and investors to panic and start to think to themselves, can I still see growth in these companies even though it's harder to borrow funds and more expensive to borrow funds? And of course the answer is no. This is when we saw the NASDAQ face its 4th largest drop in history at the time. Companies continued to burn through their piles of cash without pulling a profit, which became worthless. With fraud, bankruptcies, and more, we saw the NASDAQ reach its bottom in October of 2002, 78% down from its peak in October of 2000. Before jumping into the crisis of 2008, I want to give some background information on a mortgage and what a mortgage is. Well, a mortgage is essentially a loan on your house that you will pay with interest in 15 or 30 years. Lenders will then take that mortgage that they're receiving monthly payments and sell that to Fannie Mae or Freddie Mac. These are government-sponsored companies that buy these mortgages. Now, if the person making the payments on the house defaults on their loan or stops making their payments, their house will fall into foreclosure, and then the bank will turn around and sell that to someone else at an auction for a cheaper price. Now, the build-up to 2008 started when these mortgage lenders started becoming very lenient with who can have a loan. They started giving loans to people with low credit scores, with low income, and nothing to really back up that they're able to pay this loan in the future. At the same time, insurance companies were selling credit swap defaults, which is basically mortgage insurance if the borrower defaulted. Now, insurance companies at the time were making so much money from this that they started selling multiple CDSs, credit swap defaults, on one property. In the end, they ended up becoming responsible for an insurance of $62 trillion, which, I mean, obviously they're not going to be able to pay when it's a fan. With it being so easy to buy a house and get a mortgage, everyone started buying a house, even the unreliable ones, knowing they're not qualified. This was a recipe for disaster because, as you can see, it's just a matter of time before these people default on their loans and their houses get foreclosed. And they did. In 2007, 3% of mortgages were in foreclosure and 7% of mortgages were at least 1 month behind on payments. Because of the influx of foreclosures, we saw supply in the housing market go up, and we all know what happens when supply goes up. Price falls, and this is what led to the housing crash of 2008. Now, remember the $62 trillion that I mentioned earlier that insurance companies had to pay out if people defaulted on their loans? Yeah, well, it was time for them to pay up, and obviously they don't have it. This led to banks, insurers, and many more businesses filing bankruptcies, including one of the biggest ones, which at the time was Lehman Brothers, which was an investment company that had $600 billion in assets. Because of this, uncertainty shook the stock market, where people started selling off their assets and moving their money into more secure things like bonds, which guarantee you a return even though there's such a much smaller return. The downfall of the housing market, unreliable investments, and greed is essentially what led to the financial crisis of 2008. Well, after this, we saw regulations put into place to make sure this doesn't happen again. We saw stricter lending practices like requiring a down payment or having a certain credit score in order to secure a loan. Now, fast forward 12 years later to 2020, the first crash after one of the biggest bull markets in history. I think we're all familiar with what happened here. I mean, I hope we are, unless we've been living under a rock. Well, in 2020, in March of 2020, we saw the virus outbreak, which essentially set the world on fire. Everything was shut down and is still recovering to this day. Due to shutdowns and uncertainty of the future, we saw both temporarily and permanent job loss. Unemployment instantly rose to 15% and is still recovering. We saw the S&P sell off in the matter of 1 month, and we saw a 32% dip in the S&P between February of 2020 and March of 2020. Once this crash happened, we did see an influx of money into the economy as we saw 3 huge stimulus packages. The first one being $2 trillion, second one being $900 billion, and the third one, which was our most recent one, was about $1.9 trillion. Over the course of a year between March 2020 and March 2021, we saw an supply of $5 trillion into our economy. This is 20% of every single dollar that's ever been printed. Let that sink in for a second. Now, moving forward, after that first stimulus package in 2020, we've been seeing nothing but new all-time highs in the stock market. We've been seeing some smaller dips like we've seen maybe a few weeks ago or maybe even a month ago in the NASDAQ, which corrected about 7-8%. The reason for this is many people think that we're going to see an inflation rate beyond our 2% target. We're already seeing it in assets like stocks, housing, and even lumber, which is up to 150%. Another reason for the sell-off is that we're seeing speculation, or people think that the Federal Reserve is going to be raising interest rates. Now, we've heard Jerome Powell say it over and over and over again, but people still don't believe him, that we're not going to be seeing interest rates rising until at least 2023. Not only that, they're not even thinking about raising rates right now. Like I said, we've seen a rise in assets like stocks and real estate. So what's the cause? Well, the first cause for the rise in real estate prices is the low mortgage rates. We've seen mortgage rates as low as 2% right now, which we've never ever seen in history. Aside from the low mortgage rates, we're also seeing super high demand and super low supply. So when you have more demand than you have supply, prices are going to rise. One of the reasons for the rise in prices of stocks is that we're seeing a lot more people invest into the stock market. people aren't able to spend, well, in this last year, people weren't able to spend their money on things like going out to eat because everything was shut down, or they weren't able to go on their vacations, or they didn't even want to buy clothes because they're not going to wear it anywhere. So rather than having their money sit in their checkings account and lose money to inflation, they figured, let me buy stocks. From this last $1.9 trillion stimulus package, we've seen an influx of $57 billion of new money into the market. Now, what do we think the future is going to look like? Now that we've gone over the past crashes and everything that's happened in the past 100 years and why those were caused, let's talk about the future. When the Fed do begin to raise their interest rates, I do believe that we might see some slowdown or maybe even a decline in growth stocks. But that does not mean to stop investing. Sidelining your money and waiting for a crash to happen is the worst thing you can do, because time in the market is always better than timing the market. My plan is to continue to dollar cost average every 2 weeks like I've been doing into my long-term investment funds, whether the stock market continues to rise or whether it falls to its lowest point in 10 years. When you're in it for the long run, these small corrections or even these crashes aren't really that bad, because what they do is they give you the opportunity to average down your costs and buy everything at a cheaper price. If your company is still the same company, there should be no reason why you should stop investing into it if that's what you believe. As for inflation, in the last year, from March 2020 to March 2021, the Federal Reserve said that we've only seen an inflation rate of 1.7%. Now, this is according to the CPI, which tracks things like eggs, milks, and your everyday buys at the stores. This doesn't consider assets like the stocks and real estate and even lumber. So I do believe we might see an increase in inflation in the next couple of months, just because things are opening up again, people are going to be spending money, demand's going to be rising, prices are going to be going up. As for the real estate market, I don't believe we're going to be seeing a crash in that either. The reason why these prices are so high, like I said, is because of the demand. As for foreclosures, only 1% of loans are underwater. And for rent, 94% of rent has been paid, and that's compared to our historical average of 95%. Like I said, I only see a drop in the real estate prices when interest rates rise, which we're hoping isn't until at least 2023. Like I said, guys, this is all my opinion and it's not financial advice, so please do your due diligence before making any financial decisions. That being said, guys, I really hope you enjoyed this video and that gave you some insight on what's to come. If you guys did enjoy this video, hit that post notification bell so you know when we post next, hit that like button, and hit that subscribe button, as it really does help me push out new content.